Welcome to the weekly update, where I'll go over the action in the market for the week of January 6th through the 10th, and we'll see how things look for the week of January 13th through the 17th. Okay, had another down week. We're actually turning more negative on the daily charts. We were already negative in the short term. We tried to get the 50-day moving average back in the intermediate term. We're under that, and we're coming down. And as of right now, after Friday's close, the 100-day moving average on the daily charts is providing support. We'll have to see. Can we bounce up off of that? Now, the economic reports that have been coming out lately have been stronger than expected. Interest rates have really been going up for the most part since the Fed started cutting rates last fall. And the markets, specifically the bond market, is worried about inflation. And when they're worried about inflation, bond prices go down and interest rates go up. Well, the stock market was okay when we got over 4%, and they're kind of okay with it up to about 4.5%. We're well above 4.5% now, and that's what's pressuring stocks. Now, another thing that I'm keeping an eye on, usually I follow the 10-year bond. Right now, I'm also following the 30-year bond because we're not too far away from that 5% for the 30-year yield. If we go up and hit that, we may turn and come back down. We may blow right through 5% and keep going. And if we do that, that's going to turn things even more negative than what they were this past week. Now, we only had 4 trading days because Thursday the markets were closed for a state funeral for President Carter. But Monday looked okay. Tuesday was a down day. Wednesday was, who knew what was, there was no conviction. And then we had the employment situation report come out on Friday. That was a lot stronger than expected. And the futures immediately took a dive about an hour before the market opened. And that led to a lower open. And instead of finding some support, we just kept going down and we closed. We tried to bounce a couple of times, but by the time we closed, we were pretty much at the low for the session. And I'll have the intraday chart to show you. Okay, just a few things to go through before I get into the video. I do post videos every day. If you want to keep up to date with what's going on, feel free to tune into those. Also, I put a PDF available below every video that I post on YouTube and Rumble. If you want to download the slides, that also includes the charts, you're welcome to do that. I update pivot points every day on the YouTube community tab. There's some that last for the whole month. There's another chart that only lasts for that particular day. I do have a private Facebook group. You're welcome to join. Not really active, not a lot of people in there, but you can change that if you want to join. And then I've been having some comments coming up on Rumble again, where these social media experts, which are really scammers, they talk about how great and wonderful the videos are, but they don't even watch the videos because I provide an email address and I just delete the comments. So, anyway, and I do post on YouTube and Rumble. Here's the link if you want to check things out on Rumble. So let's go back and talk about the week session. We were down almost 2%, 1.94%. We were still below average with volume. Now, we really picked up in Friday's session, but Wednesday was below average. We were okay with volume on Monday and Tuesday. But the thing that was a little concerning about Friday was we really went down on a real increase in volume, and that's a bit of a concern. It can also point to that maybe we're hitting a climactic type bottom in the market. We're still above that 100-day moving average. Is the market going to be able to bounce up off of that? We are looking more negative now, even on the weekly charts. And something really strange happened with the next one that I'll mention right now. We actually crossed back over positive with the ADX, where we went negative a week ago. Even though we had a down week, the green line is back above the red line. Now, there's some pockets of strength. There are some things that the market can build off of. There are some indicators that I'll go through on the daily side that are actually kind of hopeful. But when you look at everything on a trending basis, we're pointed down right now, except for the long term. The long term is still holding up, but we're seeing some weakness now. And it's about interest rates. Now, and I already talked about that. In the upcoming week, we're going to get a couple of reads on inflation. We're going to get PPI, we're going to get CPI, and that's going to help dictate, okay, is inflation still becoming a problem and interest rates going up? Is that justified? Or is the market going to say, okay, inflation doesn't seem to be a real problem right now. We can bring interest rates back down. That would help the stock market. All kinds of geopolitical things going on. Not really of an impact to the stock market, of course, are the fires in Los Angeles. It's just heartbreaking what's going on there. But there's people that are involved in the stock market that are being impacted by this. But as far as actually impacting the stock market itself or any of the financial markets, it's not really having an impact there. We did get the meeting minutes from the latest FOMC meeting this past week. There were really no surprises there. It's just kind of confirmed the fears that the market had already concluded and pretty much said the same thing that Jerome Powell and the Fed said at their last meeting. And I'll go through the ADX chart here when we get there. So, just some bullet points. We were losses due There were losses in the stock market because of rising interest rates, sticky inflation. And that's kind of a new term maybe you haven't heard before. The last couple of years, it's been a big deal. It's that inflation comes down and hits a certain level, or it should be coming down and it's not, or it just plateaus out at a specific level as well. So it should be coming down, but they're having a hard time getting it to actually come down. And so this is the idea that the Fed is likely done cutting rates for right now. And so they're going to have to keep rates where they're at, higher for longer, and the market doesn't really like that. The 10-year yield ended up closing at 4.78%, where a week ago we were at 4.6%. So that's a big move for a 4-day week. And then I'm just keeping an eye on the 30-year. We're getting close to that 5% level. We're at 4.97 right now. We're going to be watching that in the upcoming week. Then the economic reports that have been coming out were stronger than expected. The meeting minutes didn't really have any surprises and just kind of added to this negative scenario the market's dealing with. And then declines were pretty much across the board. The small caps have gone nowhere. In fact, they're going down now. They had been going sideways. This January effect that is supposed to happen, and that's being impacted by interest rates because these smaller companies have to borrow a lot of money. And when interest rates are higher, that bites into their earnings and their profits. And so you can't really justify their prices going up while interest rates are going up. Small caps and mid caps thrive better in a lower interest rate environment. And until they start really coming down with rates, small and mid caps, or as Edward Yardeni says, SMID caps, are really going to have a difficult time going up. But the S&P is still above its 100-day moving average. That's on a daily chart. And then growth to value. This is one of the promising areas that we're seeing. It's still holding up. And we want growth to outperform value. And it's been doing that now pretty much since the end of November. But it hasn't really led to any explosive upside move with the indexes. But for right now, the growth to value ratios are looking okay. Discretionary to staples are looking okay. I'll do some relational studies here between different indexes. Those are still holding up for right now. So it's not like everything is turning over, because a lot of people are trying to compare what's happening right now with what happened at the beginning of 2022. Things were looking good at the end of 2021. We were setting all-time highs, but we were seeing warning signs under the surface that led into price going into 2022, which was a cyclical bear market. We went down that year. We finally bottomed in October of 2022, and we've been bouncing up ever since. The weaknesses that we look for when we're seeing a general change in the overall climate of the market, they're holding up for the time being, but this could change. So that's why I keep watching the videos, watch the daily videos. I go through this stuff really in depth and see if we're getting an overall shift in the climate like we saw at the end of 2021, going into the early part of 2022. It's not there yet, but we just want to keep an eye on it. We don't project, we don't forecast. We just look at what is the consensus right now. What's the evidence telling us? And yeah, we're pulling back. We're negative in the short and intermediate term on the daily charts. The long-term trend is still positive, and there's still hopeful signs under the surface that You give the market a good couple of days and it could bounce out of this mess. But if we continue to go down, that could change the overall market to looking even more negative. Okay, and then the dollar was up, and this has also been pressuring stocks. As I say all the time, the stock market likes a weaker dollar, and it's been going up. Now, compared to other currencies, okay, it's backed by nothing, just like all the major currencies in the world. So it's the least crappy of all the crap out there, and that's why the dollar is going up right now because interest rates are also going up. Okay, so the Dow was down 1.9%, the Nasdaq was down 2.3%, the S&P was down 1.9%. Small caps got hit. They're supposed to be going up. They were down 3.5%. This is what we're keeping an eye on because we're coming down to this area where potentially we're getting close, where if you compare from 1966 to 1982, we were going down with inflation at that time too, and then we went into a massive period of inflation after that. Now, we don't know if that's what's going to happen this time. It's happened before. We've been watching this. The bond market's worried about that. The stock market has become worried about that. We don't know how this is actually going to play out, but we want to be open to what reality could end up being. And then we're well above this 4.02% with the 10-year yield. We're at 4.78%. That's why stocks are under pressure because this is now biting into corporate profits and earnings. Okay, this was updated. The number of people that are unemployed for over 6 months, it's continuing to go up. Now, you could look at this and go, okay, yeah, maybe things aren't looking so good after all. But when you look at the weekly numbers that we get, the unemployment claims, initial claims, are actually going down. And the continuous claims have been starting to come down too. But they're a little bit stronger. It's like people in companies, they're not as willing to let people go, but the people that are let go are having a more difficult time finding a job. And that's kind of being reflected here, where we're seeing long-term unemployment actually starting to go up. Okay, then this still justifies stock prices going up. I update this every week, and this is an earnings projection going forward, whether it's Morgan Stanley or the consensus out there, and the numbers are going up and to the right. But now we're still overvalued when you compare even these forward-looking numbers to current price. We're overvalued in that aspect, but we've been overvalued for months in some aspects and years in other ways. So I go more in depth on this in the intermarket analysis video, so feel free to check that out. This is a chart that comes up from time to time. This is what have interest rates done after the Fed ends up cutting rates. Well, and then we have an average, and sometimes they go lower, sometimes they end up going higher. We're not in a recession yet. Now the debate's still going back and forth. You can make a case that we might slip into a recession. You can also make a case that we won't. I look at just as many charts that suggest both sides right now. So I keep an eye on this and we'll keep watching this going forward. Okay, then equity drawdown risk is picked up where we've been seeing the market under pressure lately here. And so that's called a drawdown. Okay, and then quarterly earnings per share on a year-over-year basis. Now, Deutsche Bank, they think we're going to go up, where the consensus is that we're going to go down here. And this is not month after month. This is not even day after day, the way we follow these. This is quarter after quarter. And if this does end up going down, that could add more pressure to stocks. Then earnings revisions for high-quality equities relative for the revisions of breadth. And they're just saying the better stocks are getting revised up and they're looking pretty good. And then their performance has also been pretty good as well. You might have some high flying stock. You might have a penny stock that you think is all great and you can buy it at 10 cents and sell it for 20 cents. Stocks are what the market determines they should be worth. And the better quality stocks are holding up better as we've been going down, and they tend to go up more when we're more in an uptrend. Okay, now this is when you look at the all employees and temporary help services. We dropped below the red line, but we didn't go into a recession, which usually is what happens. Now we're coming back up to this red line. The employment situation is looking strong right now, and that's kind of freaking out the markets. And it's also telling the Fed, hey, let's not cut rates. We're not seeing real weakness in the employment area right now. Okay, and then what do you think the return in the S&P will be in 2025? Okay, yeah. I mean, at the end of the year, people were coming out with their projections, and we could turn it around. This is just the beginning of the year, but we kind of come out around anywhere from 5 to 10%. There's one in here, it's not this chart, but there was one that I saw, it was 0 to 10. It's like, okay, yeah, that's a really nice way to predict what you think's going to happen. But there's still most people that think we're going to be up from 5 to 10% by the time we finish 2025. But this is going to change. If we turn even more negative, these numbers will change too. It's people think where things are at right now or the way things are always going to be, but they're going to change. And the market goes through really happy times and really sad times, and it goes up and down. It's just a reflection of life. But over the long term, it tends to go up about 70% of the time and it tends to go down about 30% of the time. But that 30% can really freak people out and really cause a lot of damage. All right, FactSet had a couple of posts here. How much did analysts cut earnings per share for the fourth quarter? Because we're done with the fourth quarter now, and we're starting to go into earnings season now that January is rolling around. And they cut them here, but not as much as they've cut them in the past. And we are seeing a revision down overall when you look at the fourth quarter. Then they say here that the S&P will likely report the highest earnings growth in 3 years. So they don't know how it's actually going to play out yet, but they think it's going to be really solid. It said the S&P is currently expected to report earnings growth of 11.7%. That's really good for the fourth quarter. My gosh, 5, 6% is considered good, and they're coming in over 11, almost 12%. That could justify stocks still going up at least for a while longer. Then over here, this takes it out over 5 years, and they're still looking pretty healthy when you take it all together. All right, here's the intraday chart where we go back to Monday and we actually gapped higher. Everything, it's like, yeah, the market is great. We're just going to go up to the moon. And we gapped up and then it just kind of fizzled out and rolled over. And if you look at this from Monday all the way to Friday, there's almost like a straight line. Now, Wednesday, we just chopped sideways, but then we resumed this and we actually started coming down and we hit our low earlier in the session. And I was watching this and I thought, okay, this looks really healthy. You see nothing but green here. We're going up and up and up, but then everything stalled. We got up to a certain point and then we just came back down and closed just a little bit off the low. Maybe this, and I said this in the daily video, maybe this started too early. If it had happened later, this might look a little more positive because it's the amateurs who open the market, it's the professionals who close it. That's why I focus on the close more than I do the open. So this would have been nice if we would have been able to hold on to this. This could show that maybe some hope is starting to come back in, but then we gave most of that up by the time Friday's close came around. All right, so for the week, everything was down, all the indexes. Now, this is just the 4 trading days. Here, we had the NASDAQ and NASDAQ 100 down the most. We had the NYSE and Dow down the least. And then going back to the beginning of the year, there's not many days right now, but all of the indexes are negative year to date. Then we look at the sectors, and since we had a down week, I sort this from what was down the most. Real estate, they don't like interest rates going up. The financial sector, they had been one of the stronger areas in 2024. They got hit this past week. Tech, communication, and then down here, discretionary. These are the three big growth areas. They took a hit this week, but everything took a hit. The only thing that was up ended up being energy, and that's more in an inflationary, rising interest rate type of an environment. Everything else ended up being down. Now we go over to the right-hand side on the next chart. What are the areas looking the strongest? You still have discretionary and communication, two growth areas that are in the 90s. Then you have the financial sector, which is pulling back, but still in the high 80s here. And then let's see, down here, I'm trying to find tech. Down here, weakening. This is taking a bit of a hit too. We're coming in at 45.6. So again, are we going to see a bounce back from this, or are we going to see more follow through weakness? So looking at the sectors for the week, and again, I do this in a little bit different way, just the 4 trading days. We had tech communication down the most, with discretionary also down, and then real estate was down. Energy, healthcare, these are defensive areas, and they did really well. Materials, which has just been getting hammered, it came up a little bit this week. Industrials and utilities, which had been doing really well earlier in 2024, then they started to pull back. Now they're going back up because interest rates are going back up. And then staples, which is another defensive area, ended up being up as well. Year to date, we have energy, healthcare, utilities, and industrials, more of the defensive areas and more economically sensitive areas, too, where all of the other sectors are now down going back to the beginning of 2025. Looking at our relative rotation graph, where we're seeing the discretionary, which was really strong from August when we hit that low, we just been going up like crazy. Seeing some pullback there. So, but it's still probably the best area. Now, this goes back over the last year, where we're seeing communication still strong, but getting hit. We're seeing financials, that was a stronger area, also getting hit right now. Where the weaker areas would be like healthcare, and staples, more defensive, real estate, the things that, fun. This is XLF. What is this one? XLE. Guess this is energy here. It's hard to see some of these letters. Where XLK is tech. It's blue, but it's not in a real strong area right now. Okay, and this looks at it like a spreadsheet. Financials, communication, discretionary. These are holding up the best right now over the last year, not the last week, not the last month. And then more neutral would be the industrials, and then all these other areas would be red, with tech actually showing some improvement over the last year. It's been the strongest part of the market. Looking at the different indexes here, we're still seeing a jumbled mess. The market's still trying to figure out, do we want to go up and focus on growth? That we still have evidence to suggest that, but price is getting more defensive right now. That's why you see an awful lot of red, where we're seeing utilities just continuing to show weakness, even though they had a pretty good week this past week. Here's a spreadsheet look where the big stocks, the big 100 stocks that make up the S&P 500 and the NASDAQ 100, they're still holding up, where all of these other areas are actually showing quite a bit of weakness now when you compare it to the broad market. Sentiment. Every week we get the investors intelligence survey, and they take the bulls and subtract the bears. It's coming down more neutral now. We're under that 3 level, so they're not extremely bullish or bearish right now. Sentiment getting close to that 25 level. If we drop down here, this is when we start to look at using this as a contrarian indicator. We were improving and starting to go back up, but now we're starting to come back down. This shows you the chart. We came down and actually dropped below 25. We bounced up off of there only to come back down. Then we bounced again, only to come back down. You've got a lot of really confused folks right now who thought, okay, the Santa Claus rally, the January effect, a new administration coming in, you had all these potentially positive things. Well, somebody forgot to tell the stock market that. And these economic reports have been coming in stronger than expected. Interest rates are really what's dragging things down right now. The active asset managers, more neutral, coming in at 65.35, not extreme positive or negative currently. We're starting to go back up with the VIX. We're still under 20, but if we continue to fall, we might get up into that 20 range, and that's where things typically turn more negative. And then at some point, this will top out, and that's when we hit some kind of a bottom if we still continue to fall. And then the VIX will start to come back down. And we're also climbing. We got a little close to that 20 level in Friday's session, but we ended up closing down below 20. We're still looking okay here. This is cash to the tech sector. The black line is still going down. That means tech is outperforming. Now it's bouncing back up with the latest rating, but it's still well below these moving averages here. And you got folks that are very bearish right now when they get into the RIDEX mutual funds. They have a bullish fund and a bearish fund, and this really spiked up. So when this gets to a really high reading, we use it as a contrarian indicator If they're really bearish on things, then we look to start going bullish because sometimes these folks can't get out of their own way. They, we have a really solid up day, they're bullish. And then, so they jump into the bullish fund at the end of the day, only to have the next day really go down. And then they're just ping ponging back and forth and doing exactly the wrong thing at exactly the wrong time. Okay, and then we're coming down a little bit. We're dropping below zero for the first time in quite a while with the American Association of Individual Investors. And the 50-day moving average of this survey is starting to come over too. We've been pretty positive now for quite a while. So you've got individual investors starting to get more concerned. The Ulcer Index, we're still above the moving average on the daily chart. We're coming up, but below the moving average here on the weekly chart. We're keeping an eye on the spread between risky and not as risky bonds. Not really a problem right now. It is coming down, which means that the risk is going up here, but we're not really getting a really big spike up right now. Like we're seeing the VIX, this chart shows it going down. It's inverted, so that means the VIX is actually going up. And I created this, actually someone else created this. David Keller with stock charts created this chart. Just so you kind of get a lineup of what's the S&P doing, what's this inverted chart doing, and what's the VIX doing all together, moving in the same basic direction. And we're starting to go back up with the VIX on a shorter term basis when we compare it to a 3-month average of the VIX and do a ratio. That just means things are turning more negative, but we're still going down with our very long term equity put call ratio based on 253 periods. That's continuing to fall. We're still below the black line with the Chicago Financial Conditions Index. That's not signaling any problems according to this chart. We're still coming in positive for GDP. We're at about what, 2 3/4 right now. The consensus is about 2.5 or so to the upside and about 1.5 to the downside. And we're coming in at 2.7 right now for the projection for what it'll be for the fourth quarter. And these are all positive right now. When we go into a recession, all these GDP readings will be negative, but they're not negative now. And we're coming down with the real-time SOM rule recession indicator. We went above 5, and all the perma bears were just giddy with delight. Well, we're coming down because the employment situation is still looking pretty strong. Usually when we go above this red line, that's when we go into a recession. Well, now we're coming back down, so we're kind of getting farther away from that. And here's the smooth U.S. recession probabilities. It's going up a little bit from the black line, but still well below the red line. This wasn't updated recently. This is a quarterly report, the Brave Butters Kelly Leading Index, where the last time we had this updated, it was actually coming down. Inflation, we started a new quarter with a new year, and so we're not getting much of a change here, but we will get PPI and CPI in the upcoming week. And pretty much certain now that the Fed is going to keep rates the same, 93.6% chance at 4.25 to 4.5, which is where they're at right now. And markets pretty much lock that in, that the Fed's not going to do anything. So now we're starting to look out at the March 19th meeting, and a little bit more of a lean because of these strong economic reports are going to show that interest rates will be the same after that meeting, where it was closer to 50-50 before. And this shows how this changes over a period of time, but that's still kind of off into the future. Showing the balance sheet is still going down overall. And then we look at a year-over-year basis where it's still going up here, even though it shows a negative number on top. And we were a little bit concerned a week ago with the overnight reverse repurchase agreements. We were spiking up. Now we're starting to come back down. So this was causing a little bit of a concern, but now that this has been updated, things don't seem to be as concerning right now. So looking at breadth, we're still positive on the daily charts, but we're coming down based on price and volume. We're also coming down here on the weekly charts, but still above these advancing moving averages. We were starting to look a little better on the daily charts when we look at the new highs and new lows, but we're still negative here on the weekly chart, and that's showing internal weakness. But if you look at the 10-week, we're flattening out, and we're starting to turn up with the 4-week. We were starting to turn up with both of these on the daily charts. I have a 5-day and a 10-day on the daily side, but then we lost that. Any improvement that we were seeing went away in Friday's session. coming down, but still positive with the advanced decline ratio. We're negative on the daily chart, both with the 19-day and 39-day. We're here, this is a 19-week and a 39-week. And we're turning more negative here on the weekly chart. Oh, this is a daily chart. Okay, this is a mistake here. Well, here's a daily chart to show you. We're still holding up okay. I saw the weekly chart. I just copied the wrong one here. So we're actually looking a little more negative here with accumulation distribution. So this is what's strange. We crossed over with the red line above the green line a week ago, and then we're down almost 2%, and the green line goes above the red line. The ADX is picking up something positive that's happening that we're not seeing based on price yet. So we're leaning a little bit more positive. Now we're not trending because we're below 20 with the ADX and we're below the moving average. So we're not trending, and it's a weakening trend if there even was one. But one thing I want to point out here is notice how we broke below these previous lows here. That could be kind of negative because we come up here, we set a high, then we came back and set a lower high. Now we're setting a lower low. We want to watch the bars themselves. I'm not into wedges and triangles and all that stuff, but I am into looking at, okay, what's going on with the bars themselves? And that's looking kind of negative right now. And we're still positive with the Arun, where we're extreme negative right now on the daily chart. We're seeing on the daily chart where the line is crossing above the red dash line. We're not there here on the weekly chart. And if you want to know more about the mass index, which suggests a change in trend, please go over and look at the daily video. Longer term, though, first we look at a daily chart where you can see on the daily chart, we're breaking out to a lower low here after we set two higher highs on the daily side. That's not very comforting right now. So the chart is not looking all that healthy. And Friday, we were above average with volume, but we spent a lot of the week below average. And then we had only 4 days, so that's going to chop off the average as well. And this is where things kind of started. And I've been showing this in the daily videos. Now, even though we went above this trend channel in 2021, that led us into 2022. We came right up to this trend channel, and that's when we set the high for the S&P, and we've been coming down ever since. And this is overhead resistance that at some point the market hopefully will deal with if it tries to go back up. We have some new pivot points now with the new month. We're right in between. We're slightly positive because we're above the P here. That's the pivot. And when we're above that, it's longer term positive. If we drop below the pivot, that's going to be longer term negative. But when you look at the long term trend, we're coming down, but the red line's still going up and we're still above the red line. Now, when you look at these moving average crossovers, we've dropped below the blue line. That's 13 weeks. And so that's more short to intermediate term negative. But the longer term trend is still positive. And we're coming down below zero with the McClellan oscillator. That's more negative. We're also coming down and below zero with the summation index based on price and volume. That's negative. And we were trying to bounce back up with the bullish percent index, and we came right back down. We gave up the gains that we were seeing here. So since we're below 50 and now going down, that's also more negative. And we came up with the Swenlin trading oscillator based on price and volume. We were actually looking kind of positive before Friday. Well, we lost that on the daily chart, but this could give a little bit of hope here. Now we're still negative, but we are going up in the latest week. Momentum is pretty negative. We're rolling over with the PMO. We're below zero based on price and volume. And coming back down with the PMOs that are rising, that was a sign of hope that we were hanging on to. It's not there now. This is still a sign of hope where we had got extreme negative with the buy signals and now we're coming up and this is still going up. But when we look at the PMOs that are above zero, that's continuing to decline. And coming right down and dropping a little bit below the midpoint here with our Bollinger Bands, the percent B indicator. That's slightly turning things more negative. The shaken money flow, we're actually seeing a little bit of an upward move on the daily chart after Friday, even though we had a down day. This is still positive, but it is coming down and the red line's going down. So this is more negative right now. Momentum, we're going down with our short-term oscillators, intermediate-term oscillators. We're still looking positive with the long-term oscillator, the KST, but we're starting to roll over with the tricks. And we're negative across the board on the daily side. We're coming down with the chicken oscillator, but we're still above zero. We're also we saw a little bit of hope after Wednesday that we were starting to tick back up on the daily chart. We lost that on Friday. So this is negative on the daily side, and it's looking more negative here on the weekly side. And we're negative with the force index, both on the daily here and here on the weekly chart. We're negative with the money flow, where we're coming down but still above 50. And we're extreme negative here with the Stochk RSI. But we've been negative with this for a while. The Williams percent are looking more negative, crossing below the midpoint. And we're still above 50 with the RSI, where we're below 50. I use an RSI 9 period and a 14 period based on daily charts on the daily side. This is a 14-week calculation here, where we're showing some weakness now, but we're still above 50. And we're coming down, but still above 50 with the ultimate oscillator. We're coming down with the vortex. It's still positive, but the green line has been coming down. But now the red line's actually going down a little bit. Momentum on a longer term basis, as measured by the copy curve, is negative. And we're also negative on the daily side. We had a down week, so we're below zero with the rate of change. And we're starting to come back down below this red line with our 50-week rate of change. We're still positive here. This is a very long-term oscillator. We crossed above it positive in November, and we're still above it. It's going to take a lot to shift this over to negative. And this is more negative, though. This is a 10-week moving average here, where we came back up and we looked like we were going to try to break above that. No, we lost it, and we actually closed further below it. If we really start to scream to the downside, we're going to be watching this red 40-week moving average here. To see that kind of equates to a 200-day moving average. So the hope is that at some point we'll get some support in here and we won't even come down and test this. All right, so we're more negative now in the weekly chart with the Heiken Ashi. The Kagi chart is red and going down. That's negative. We're still positive with the Renko chart. Sometimes it goes to sleep for a little while. And we're still positive here with the three-line break. So we're seeing kind of a mixed picture longer term with our trend. And we saw some new X's drawn in when we had that up part of the week. That actually helped the market. But unfortunately, on the daily side, with the downward move, we had three O's drawn in on the daily chart. So this is still looking positive longer term. There's no signal that's been generated, but this is holding up for right now. And we're actually ticking up a little bit with the ease of movement, and we're still above zero. And I just use this for entertainment. We're probably coming up to another new 50-day cycle. And the momentum, though, we're looking more negative. We're starting to come down with the long term, intermediate term, and the short term. And we've gone from neutral to negative now with the Elder's Impulse System here on the weekly chart. We're still negative with the the weekly parabolic SAR. We're also negative with the daily chart. And this is more on a daily basis. We're negative with stocks in the short term. We're negative across the board with bonds. That's because interest rates are going up. Commodities, that's kind of inflationary, going up in the short and intermediate term. The dollar is really strong on all time frames. Okay, and then, all right. So then we look at the decision point scorecard. We haven't changed. If you saw this previously, still negative in the short term based on trend, negative in the intermediate term based on the PMO, the price momentum oscillator. So coming down here with the S&P, just really going nowhere with the mid caps. And actually, we had been going sideways with the small caps. Now we're starting to see them go down. And the Dow is underneath still. It's 13-week moving average, but the longer term uptrend is still intact. The NASDAQ, this was kind of discouraging in Friday's session. We've been holding out above this blue line on the daily chart and here on the weekly chart. We closed a little bit below it this week, and on the daily chart, we broke the 50-day moving average. That had been an area of hope and support for the market. The fact that we closed down below that could suggest things are more negative. Now, we could get that back. Sometimes the markets overshoot to either the upside or the downside, but we'll just be watching that. And we also dropped below the 50-day moving average on the NASDAQ 100. We're dropping a little bit below the 13-week moving average here on the weekly chart. And so we had a nice red candle coming up here, looking more negative for the Qs. The mid caps underneath the 13, but still above the 50-week moving average. Small caps looking more negative. Now, another thing I'll point out with the small caps, we came down to the 200-day moving average for the small caps and we closed up off of that. Is that an area of support that the market's going to get? You're going to have to watch the daily charts for that. The Wilshire, this is a daily chart, lost the 50-day moving average and breaking to a new low here after setting a lower high and then another lower high and now another lower low. So you can see the concern that we see in this chart here. It's not really healthy right now. The NYSE underneath the 13 week, still above the 50 week. All stocks under the 13 week, still above the 50 week. The FANG index, these are the big stocks, the mega caps. This has been holding up better. Now they got hit this week too, but they're still above their 13-week moving average. ARC, it was down almost 4%, coming back down close to its 13-week moving average. The banks, which have been really strong here, been seeing some weakness now and closed at the low for the week, coming down just a little bit above 50 with the RSI, but the momentum is switched over to negative, where it's been kind of choppy for most of 2024, but then was looking really strong. Now it's starting to turn more negative. Looking at basic Dow theory, where we're coming down with the Dow, we're also coming down to sideways with the transports. The utilities were really strong. They were coming down, but they ended up being up on the week. And this is kind of taking a hit too. We go back to 2020 and look at how did the S&P perform over the last 5 years. And we were up about, I think it was about 60% of the time with a lot higher return. Well, based on how things are at right now, we would only be up 40% of the time over the last 5 years with a gain of 0.1%, which is virtually unchanged, but it's still positive. Okay, the broad market, we're seeing a real resurgence of commodities, both on the daily chart and here on the weekly chart. Oil has been starting to go back up again. There are geopolitical things that are going on, but this seems to be more technical at the time being. Copper, it's going back up again now because the economy's looking stronger. Gold has been just going sideways. It came back above its 13-week moving average. Silver came down to its 50-week moving average and is bouncing up, but still hasn't come back above its 13-week moving average. The dollar's been really strong here. If you want to go to Europe, you want to go to Britain, you want to go to Japan, you're going to get a pretty favorable exchange rate if you decide to do that. And I've been watching this in a daily version of this in the daily videos, where I usually don't show this chart. I usually just look at it over the weekend and I show it in the intermarket analysis update. We're dropping below long-term support. Now, this red line, that's a 50-week moving average. That equates to a 200-day moving average, and we're dropping below here. And we were thinking that maybe this would be a support level that would hold, and to right now, it has not. But stocks to bonds show stocks still outperforming on a monthly chart because bonds have been going down and stocks, they've been getting hit, but going down less. So this ratio continues to go up. And this is what we're seeing here. We were coming down with interest rates. Then the Fed comes in and cuts rates. We go back up with interest rates. And then this is when the market was doing pretty good as interest rates were coming back down. Now we get these stronger than expected economic reports and interest rates are really going back up. We want to keep an eye on Japan. This is a weekly chart of international rates. They're going up there. The big freak out that happened last summer was because we were getting above 1% with the Japanese 10-year yield. We're up above that now. Is that going to trigger some kind of a problem similar to what we saw last summer? Okay, then some relative studies. Here's the intermarket analysis. And still, we haven't had enough time pass. So I'm still going back to the beginning of 2024. Gold doing the best, followed by stocks. Then oil's been bouncing back in the dollar, where bonds are down based on price. Probably at the end of January, I'll switch this over to a 2025 chart. The NASDAQ 100 to the S&P 500, still holding up. Now, it's not really going up right now, but it's still hanging in there. The S&P 100 coming down compared to the S&P 500, but still over the long term has been outperforming. Growth continues to outperform value, even though this is rolling over for now. And bonds continue to underperform stocks, even though they've been bouncing back up. Low volatility stocks, these are just getting hammered when we compare it to the S&P. Continue to go down. This is giving us a little bit of hope. If the market was getting ready to be more defensive, we would see this ratio going up, not going down, because this is what we started to see at the beginning of 2022. This was really starting to go back up. We saw a golden cross with this ratio. And as we were going down with stocks, this ratio was going up. We're not seeing that right now. So this is longer term, more positive still. But we'll keep an eye on this because it can change. Discretionary to staples. This is another growth versus defensive area. This is holding up for the most part. Discretionary was actually up with this ratio on the week. Energy bounced back compared to tech, but still longer term, energy is underperforming tech. Gold is holding up a bit better right now compared to the S&P, but we're pretty much still going sideways. And this is going down for right now because gold has been going sideways to slightly lower where the dollar's been going up. And we look at small caps to the tech sector, small caps are still really struggling longer term. Long term here, NYC breadth thrust, not much of a change here. This is going down right now because of the weakness that we've been seeing. It doesn't look like we're going to get a swag NYC breadth thrust because we had to come up here and within 10 days get up to this red line. I mean, stranger things have happened, but it doesn't look like this is going to play out. We're still on a full-on buy signal with the Zohorchak method. That hasn't dropped back, at least yet. We're still looking good with our longer-term weekly trend of the S&P. Also looking good here with a further blow up of that same trend. We're still holding up here with the NASDAQ 100 weekly chart. And the ratio between growth, the NASDAQ 100, and value, the Dow, that's continuing to be quite strong. And the Qs to small caps, still looking really solid here. These are areas of hope that we're still latching on to. But we're going down here. When we look at the 50-period moving average of the new highs and new lows for the S&P, we're still above zero, but we've been declining now for quite some time, and that's more internally negative. Also coming down with the NYSE 50-period moving average, but we're still above zero. And we're keeping an eye on the 3-month yield. And it's been coming down, but it's not crashing down like it was back in 2007 into 2008. So even though the financial sector has been getting hit, we're not seeing the things that were happening that led us into the great financial crisis, at least yet. And we're still going up with our cumulative new highs, new lows for the NASDAQ, but we're on a daily basis, we're negative now, so we're below zero. And then here's an update of the Hindenburg Ulman. The Perma Bears love this thing. We do have a confirmed spike, but we haven't seen an additional spike. Now there's a 1-day lag with this, and this is a daily chart. We'll have to see if Friday's action caused some new kind of confirmation signal. Seasonality, not really great with January. We're up 58% of the time with a return of 1.1%. We're not seeing that now. We're down, both based on our winning percentage and our return. But when you look at November to April, this is the best performing part of the year. Then when you look at November to January, this also tends to perform quite well, but not right now. And we're coming in the first half of January. We'll be finishing that out and then starting the second half. But this tends to be a stronger performing part of the year. The second half does well, but usually not as good. And then this is the whole quarter where it does okay, 0.1%. And this is the first year of a presidential cycle. And sometimes January can get off to a rough start. So thank you. I really hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.